Hi, Prashant. Yes, what a rally, really, right? Rising COVID cases or regional lockdowns, the market simply doesn't care, at least not right now, anyway. Let me straight away take it to Krishna Kumar, Chief Investment Officer at Sundaram Mutual Fund. Krishna Kumar, thank you for joining in. And that's really my first question. This market is moving and climbing all kinds of walls of worries. Does it concern you? Do you think the rally is getting excessive? Or do you think that rightly so, the market is simply discounting a future 7, 8, 9 months down the line, which looks perhaps better than where we are today?
I think we had a panic fall that happened in February, March, right? So from there, I think the markets have been following the data that's been coming through in terms of the economy is opening up, the utilization levels getting better, and activity trackers. So along with that, also the markets are looking at the kind of easy liquidity that is there, and the improvement across the board that we are seeing in different geographies. While we also understand that we've been starting to live with COVID and managing to operate at 75-80% of the economy in terms of operative levels. So these are the positives that the market is taking heart from. It is taking heart from the positive news flow coming in from development of vaccines going into phase 3. 3-4 of them probably will get approvals over the next 3 months. So some of these are definitely positives. So we are having a fairly well-rounded, diversified rally in the markets, which has been touching across the large caps, mid caps, small caps, across sectors, whether it's cyclicals or more defensive growth, which was the first one to recover, except the financials, which are a bit laggards at this point in time, given the uncertainty around the moratoriums and stress levels. So I think markets definitely have been responsive to the improving data and also differentiating across sectors like financials vis-a-vis the rest, and also seeing across stocks in terms of the impact. So I think it's been a very balanced move, and not any euphoric one, I would think.
Krishna Kumar, balanced move, but this you also obviously are seeing this rotation, right? What does it tell you? Financials, there's IT, there's energy towards the end of the week which has gone by. It's not staying. Yeah. I mean, it's everything gets ramped up very, very fast, and then the market moves on to the next set.
So I think people are trying to rotate excess weights on a trading basis, but that is essentially coming from a lot of the retail participation. You would have seen in the last 1 to 2 months across the globe, and particularly in India, the non-institutional business is probably about 80 to 90%. And the delivery buying has become a lot more muted, relatively speaking, over a 6-month period. So it is basically, those momentum players who are basically getting in, getting out of sectors and causing this kind of a perception of rotation, which is clearly, what you mentioned. But if you look at more the institutional investors, you do see that they are getting themselves positioned well across sectors, basically, except probably on the financials, where they are a lot more circumspect. But otherwise, I think across other sectors, which are a lot more, showing improvement, they are definitely getting back in. So I would think that it is more the non-institutional players who have increased the volumes, and which are also responsible in some sense for this kind of a perception.
Okay. Krishna Kumar, let's talk about some of the themes that the market has really latched on to in the last couple of weeks. And one of them definitely is IT. And most of the companies delivered better than expectation. I mean, they're all talking about growth second quarter onwards. Some of them reported improved margins. What is your outlook on this sector, and how are you positioned in IT in your portfolios?
The software IT services sector definitely, has been a positive surprise from, the results. While the top line, performance has been more or less along expected lines of a decline across companies. The cost-cutting measures that the companies have been able to get to have ensured that their profitability has been protected a lot more than expected. So on the bottom line, things have been looking a lot better. They also been able to, use the last 2 months of the quarter to wrap up deal wins, and the momentum in deal wins in the pipeline do seem to be very strong. So these basically, along with the fact that the main chunk of IT services revenues which come from the BFSI space, the US and the European banks have seen very, very steady and stable, performance in the last 3-4 months. Unlike the Lehman crisis, when you saw a lot of banks go under and create pressure for IT companies. This time around, you've not heard of any banking failure across the globe. So the business, the BFSI business, about 30 to 40%, the largest in the ITPs, has been quite steady. Just a little disruption in terms of work from home, etc. But otherwise, that's been a very stable piece this time. So that's been the positive surprise, and these guys are further investing in a lot more digital initiatives, business development, and also moving on to the cloud. So a lot of businesses are moving on to cloud in a very accelerated manner, given that we have seen that a lot of brick and mortar businesses can move board into the cloud. So there is a faster adoption, and Indian vendors who are partnering with global cloud services and infra providers are enjoying a huge improvement in business on the digital front. So we see specifically companies in those digital revenue streams will be better placed in the next 1 year. So from our perspective, we were a little cautious heading into the results, but we did understand from the US banking and other European banking spaces that the business revenues have been pretty solid. So we have been able to neutralize our exposure there, and we are positive on IT at this point in time.
Okay, that's a nice round.